Yes. A warm good evening, members. A warm welcome to the virtual CPE Meet on Joint Development Agreements, Income Tax Perspective, and Interesting Issues in Capital Gains, organized jointly by Warangal and Karimnagar branches and Nizamabad CPE chapter of SARC of ICI. Today with us, our chief guest, renowned past CCM CA G. Shekhar Garu from Chennai, and eminent speaker CA Suresh TG Garu from Chennai. I welcome to you all. Now I request all the members kindly stand for the lighting of lamp and institute motto. Virtual.
य एष सुप्तेषु जाग्रति य एष सुप्तेषु जाग्रति कामं 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 कामपुरुषो पुरुषो निर्मिमाणः निर्मिमाणः तदेव शुक्रं तदेव शुक्रदब्रह्मा तद्ब्रह्मा तदेवामृतमुच्यते तस्मिन् लोकः शतः सर्वे तदूनात्यति कश्चन एतद्द्वैत 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 एतद्द्वैत.
Thank you, all the members. Now I request our Karimnagar branch chairman, CA Tota Anjaneyulu Garu, to give his opening remarks. Over to you, sir.
Thank you, Argaru. Good evening, all the members from Karimnagar and Warangal and Nizamabad CPE chapter members, and today's legendary Guru Garu, income tax Guru Garu, and well-known faculty and past CCM G. Shekhar Garu, and renowned speaker TG Suresh Garu. A warm welcome, sir. On behalf of Karimnagar branch and Warangal branch and Nizamabad CPE chapter, a warm welcome to today's seminar, sir. Thank you for accepting our short-term invitation. Please enjoy this session and utilize the opportunity. Thank you giving the opportunity. Over to Harikrishna.
Thank you, sir. Now I request our CPE convener, Nizamabad chapter, C. Ambarish Garu, to introduce today's chief guest, C. G. Shekhar Garu, past Central Council member.
A very warm welcome and a very good evening to all the participants and the very learned chief guest of today's program and the faculty for today's program. It is my privilege to introduce today's eminent chief guest, Mr. G. Shekhar, BCom FCA, is a member of Central Council of the ICI from the period 2013 to 2022. He has acted as the chairman and the presiding officer and vice chairman for various years for various committees. and he was a member of the 13 committees of the ICI during the term 2019 to 20. He's a very eminent personality, and he's a great motivator for chartered accountants in practice and in employment and CA students through his effective and convincing communication style. He is the founder partner of G. Shekhar Associates and is in practice since the last 36 years, since 1986. He is the founder and faculty for direct taxation in Sri Guru Kripa Institute of Management, an institution that is providing education for all levels and all subjects of chartered accountancy course, and has trained many finance professionals. He is a commerce graduate, a gold medalist, and a rank holder from the Viruddhanagar Hindu Nadar Senthil Kumara Nadar College, which Madurai Kamraj University. He has done his articleship with Sri S. Sanmugavel, FCA Viruddhanagar during 1982 to 84. He has done his industrial training at Chennai Petroleum Corporation Limited during the period 1984 to 85. His professional profile, he is a member of the Expert Study Group Committee of CBDT and to study the Direct Tax Code Bill in 2006. He is a member of the Direct Tax Law Committee of the ICI in 2011-12 and Vice Chairman in 13-14 and Chairman in 14-15. He is also a recipient of Special Award from the Income Tax Department in 2011 during their 150 years of income tax in India celebrations for his contribution and service to the Income Tax Department. He is a speaker on budget presentation in Doordarshan and Sun Television. He has participated in various live public interaction programs on Sun Television to create awareness among the public on various legal issues on taxation and education. He is a well-known speaker and he has conducted career guidance program for commerce curriculum by the Dinamalar magazine and has addressed more than 1 lakh students in last 5 years in Chennai, Coimbatore, Tirupur, Salem, Madurai and Puducherry. He is writer of articles of professional interest in journals like Taxman, Financial Experts, CTR, Business Line and others. He is a well-known speaker in various seminars, workshops and programs conducted by ICI and its branches and Chamber of Commerce, Income Tax and CAG offices throughout the country. He is a faculty member of the ICI and other professional management institutions for CA Intermediate, IPCC, CA Final Level and others. He's been working with Income Tax Department in various capacities, that is training of assessing officers for conducting assessments, training of income tax officers and IRS officials at various forums, including the NADT of the Ministry of Finance. He was presented cash award. He has presented cash award to various rank holders, state toppers, district toppers in various parts of the country. His contribution towards e-filing of income tax returns, module by module testing of e-filing of income tax returns, and providing help desk support to the IT department is really commendable. He is a member of various associations like the Society of Auditors Chennai, the Chartered Accountant Study Circle Chennai, the Bombay Chartered Accountant Society, and the International Fiscal Association. He has authored many books, and the list is not exhaustive. So it's a very, very big, long list where he has written a lot of books, and most of these students and even the chartered accountants at present have benefited from the books that have been written by sir. It is really my privilege to introduce Mr. G. Shekhar. Thank you, sir. Thanks a lot for accepting the invitation of Nizamabad CP chapter. Over to you, Mr. Hari Krishna. Hari Krishna, sir, you are on mute.
Thank you, sir. Thank you, Ambarish Garu. Now I request today's chief guest and eminent speaker also, and past Central Council member, and most of the CA students, Guru, or G. Shekhar Garu. Sir, over to you, sir, to speak on this occasion. Over to you, sir.
Thank you, Hari Krishna, Secretary of the Warangal branch. Chairman of the Warangal branch, Ravi Kumar ji. Chairman of the Karimnagar branch, Tota Anjaneyulu. The convener of the Nizamabad CPE Study Circle, Ambarish Chandana. And all the committee members of the branch and the CPE circle. All the participants, senior professionals, and the today eminent speaker in specific, my friend, I can say philosopher, faculty, who is one of the major contributor in taxation for the benefit of the students and members, TG Suresh. I am very happy to address the Warangal branch. On my introduction, I given about where I done articles. After 36 years of practice, why I gave that where I have done articles, because today the psychology among the CA professionals, we are doing practice in a small Mofassil area. We came from a small town, small place, opportunity is restricted. Like that is our views on our own mind. And unnecessarily we are pulling our own leg in our growth. Today I checked up with the Warangal chairman, Mr. Ravi Kumar sir. He said, Warangal sir, more than 200 chartered accountants are on the list. And effectively around 70 to 80 chartered accountants are actively there. So he gave me a data. So considering that, the place from which I started my articleship and came to Chennai, even today in a place called Virudhunagar, only 18 chartered accountants are there. When I was doing articleship, only 3 chartered accountants. Only 3. I am the first article clerk for my auditor. So we studied in a time. Why I am telling all these things today, young chartered accountants are coming. Practically, if you watch, the number of chartered accountants in India up to 2007-8, only 1,20,000. That is first 55 years, almost 56 years of chartered accountancy institution, only 1,10,000 chartered accountants in this country. But today it is 3,45,000 chartered accountants. In the last 15 years, 16 years, every day, every year, average 20,000 to 25,000 chartered accountants are added in the list. Okay, other side is economic growth, new venture, foreign industries came. All these things are there. I'm not denying. When I qualified, only we think of some insurance company employment or some public sector employment. That is a very big employment. Or you have to get employment in ITC or Hindustan Lever. But today opportunities are very high even in employment circle. So the place from which you start your career is not the question of yardstick for your growth. The place you want to reach, because I can happily share with you the sitting council member from your region, because Mr. Prasanna Kumar, if you take, he is from Tirupati. And articles at practicing at Vizag, not a metro. So let us don't keep a place as a place of our practice is a yardstick for our growth. That is the first point I would like to share with you as a past council member with you. Second, even though we are not happy with the pandemic, so many people, so much of losses, so much of tension for the industry, individual, family, economy, country, all these things are there. One thing we have to understand, today I am sitting, everyone sitting at our office, we are able to interact with most confidential technology. So we have to thank the technology. Here I would like to love to share with you, in early 90s, I'm thinking about 92 or 93 or 95, exactly here I'm not able to remember. When income tax department want to bring computer for preparing assessment order for data creation in Chennai, the employees went on strike, loss of employment. There is a possibility of loss of employment. I know that in the strike, I came to know from some of the top officials, They put the safety pin inside the motherboard, make the computer not work. But today, the India's economy, GDP is maximum contributed by the technology, our software industry. And today we are sitting at the faceless assessment, return on income. Even I would like to share with you the evaluation of income tax. 2006, government want to introduce e-filing of return. First year of e-filing of return, mandatory for companies. It is the Congress period. P. Chidambaram was the finance minister. Actually, the software at that point of time is tested in my office. We worked in help desk. That time I addressed lot of meetings on e-filing of return. Members also asked me, Shekhar, you are for the department or for the practitioner? Government want to bring some software and other thing. It is not functioning properly. Why you are supporting all these returns and other thing? Why I am sharing all this experience? The chartered accountant who started practice in the last 10-15 years, the amount of comfort, the amount of pleasure or amount of what I can say from the I don't want to use the word tax departmental pressure is now going out. Because I know when I was earlier year of practice up to 2006, on the due date of filing return, if we go 4:30, they will close the counter. Chennai like metro. At least Mofazal area, you can use your good office, metro. 4:35, you want to file your return because of some traffic jam and other thing, you are delayed. The departmental clerk, not even clerk, the class 4 sitting, and I am not degrading the position of the person sitting in the counter who is receiving the return, who is having power to receive the return, simply tell, sorry sir, counter closed. You come on Monday. Friday evening counter closed. You come on Monday. Belated fee, interest. So then you have to go and beg before the assistant commissioner, jurisdiction officer. Please, 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 like that. Today, at my convenience, at our convenience, at our wish time, even midnight, 12 o'clock on Sunday, I want to file my return. I want to file my appeal. Everything I can do it. Okay, technologically, there is a problem here and there. See, because of the new income tax portal, we find a lot of problem. But it is a convenience. So many times you could have also faced this type of situation. People are one side, we are opposing faceless assessment. Other side, you see how much of our time and energy saved. Some occasion, hearing notice could have put 11 o'clock. We could have gone by 10:50. Some other chartered accountant went inside. 2 hours we'll sit just like that outside the income tax office. 12:30, 12:45, that assessing officer will come on and tell, I am going for lunch. Either you come on the afternoon or come on some other day. You take adjournment. The whole day gone. But today, whenever you want to file your reply, you can file faceless. So the technology also grown on the assessment side, every side. So which is helping the society. But I don't want to go on that side. Today, the branches, 3 organizers joined together, taken a joint development agreement. It is one of the very, very important in Mofasal area, because this document joint development and joint development structure started in city, and so many tribunal high court decisions has come and the issues on how to draft the joint development agreement. Because I don't want to go inside the subject, because TGS means capital gain, means TG Suresh means capital gain. This is the code word used by the young professionals in Chennai. So I don't want to go into the topic. The area in which you selected the topic, that is the joint development agreement, I know very well the speaker will be able to, TG Suresh will be able to explain the position, how to draft the agreement, because the agreement only ultimately speak in joint development agreement when the transfer takes place, when the income accrue or arises. It is not on the transaction. Transaction may be joint development agreement, but the clauses and the words used in the joint development agreement only determine the time of transfer, the time of taxability. Because one area we used to love the capital gain chapter is, chapter wise it is a very, almost more than 25 to 30 situations of computation of capital gain is there. But every amendment in capital gain chapter will have a small history of a Supreme Court decisions for such particular amendments. Every subsection, if you ask TG Suresh also, he will, because today's topic he can't go, but he can in a position to tell that every chapter, because such an interesting area. And for the practicing member also, if you are giving a right suggestion, you will get a good amount of consultancy also. But being a Mufassal in practice, I would like to share one important information related to practice, nothing related to tax. The biggest mistake as a chartered accountant we are committing. TG Suresh is also expert in costing also. He is not only a tax guru, he is also a costing guru. He could have taught the ABC. I am not talking about costing ABC. I am talking about ABC for practice. Activity-based charging. We chartered accountants are charging annual retainership fee. Why our service is not evaluated? Why we are not able to grow like a big firm or big four? It is not because of client, it is because of our attitude. Just because of our attitude. I give you a small example on capital gain. When you are traveling in a car along with your family member, one of your prime client will phone you. Sir, 20 years back, I purchased a land, sir. The cost of the land I purchased for 1 lakh, sir. Today I am selling it for 75 lakhs, sir. You are driving the car and speaking on the Bluetooth. Immediately your mind think over, okay, 20 years back mean 2001, 2002. So fair market value that time will apply. Today the indexation number is 317. All my mind start working. Then he will tell, oh, what price you purchase 1 lakh? Okay, you estimate 1 lakh, registration charges, all things. When you are driving itself, all your mind work, 75 lakh. What you are going to do? So, sir, I need this money. I need at least maximum money, but I don't want to pay lesser tax. Please address me. Immediately will tell, like a Sai Baba, why fear? I am here. Across the table, driving the car. Clientele capital gain tax is 75 lakhs is the selling price, 1 lakh is the purchase price, 317 indexation number, even if I take fully, 72 lakhs is the capital gain, 15 lakhs nearly capital gain tax. 15 lakhs nearly capital gain tax. You will across the table advise, you don't worry. We can make a small planning. Oh, your son is major. We can make you can give the property 50% to him. You can create an agreement and you register before the sale. Then you sell it. Then 54 EC, you can claim a exemption, investing in bonds and other thing. So no capital gain tax. Everything is saved. After doing all these things, you are coming to the office, sending and raising a bill for 25,000, lowest amount I am telling. Sir, 2 minutes you answered my query, you are asking for 2 minutes, 15 lakh, 25,000, sir. The client never realized, because of your knowledge, because of your intelligence, because of your fingerprint updation efficiency, you are able to save him 15 lakhs. He doesn't know about the bonds. He doesn't know about the indexation number. Because across the table you are serving. You have to serve like a 5-star or a big 4. You order for your water, water will come after 10 minutes. You order for a coffee, before coffee, the spoons, cloth, everything will come and sat in your table. After 20 minutes, only coffee will come. If you are in a well-organized firm, what they will tell? Same person, same intelligence. Same person, same intelligence. Over the, oh, you are selling for 75 lakhs. Nearly 15 lakhs of income tax you have to pay for that. Capital gain will come. Because even you give indexation, only 3 lakh advantage as per the law. Surcharge, because capital gain is above 50 lakhs, 20% tax, plus the surcharge, all put together, it will be added to your other income also. That means sometimes it may exceed 1 crore or 2 crore, additional surcharge, all things you have to calculate, you give you a big figure of tax. Don't allow him to sleep for 2 days. After that, you call for the purchase document, sale document, work out slowly. After that, you give a 5-page report. All these things, work job I have done, call to your cabin and say 25,000. Silently he will pay. Our attitude, we want to prove our client, I am so intelligent. The client doesn't value what is the value of your service for him, value of your service for him, value of benefit for him. He think only the 2 minutes. For keeping the knowledge in 2 minutes, how much hard work every day we are putting, he doesn't know. So, value yourself and what is the advantage for the client, and make activity-based charging. Every activity, no activity is free of cost. Firm returns mean this is the cost, partner return means this is the cost, company return means this is the cost, company law return, this is the cost, GST return, this is the cost. No client go out of your office without paying any fee. Because you are running your office only for your client. You are paying electricity only for your client. You are paying internet charges only for your client. You are updating your knowledge only for your client. So please, the attitude change in senior professionals are more necessary, because we are thinking that the clients are 20 years, or he is serving with me for 25 years, sir. 50, 30 years clients are such a loyal client. No client is loyal when the problem comes to him. It is my experience as a disciplinary committee member. No clients, when the disciplinary proceeding comes from some other end from the government, no clients come for the auditor support. I was, everybody want to save the state. That's the reason why I want to tell only one important, my experience sharing. Except your spouse, next step children, none of your clients are life friends. They are only client, they are working for their profit. There may be exceptions, but 95% are only like that. So, learn to charge activity-based charging. And the capital gain chapter, I already told the joint development agreement, which is one of the important area for the places like Karimnagar or Warangal, where the flat promotions and other things are taking place, chargeability of capital gain taking place. Even in the joint development agreement, how the owner can claim exemption for taking some of the part of the houses as a thing. All these things the speaker will explain to you. So I thank the Warangal branch. Before closing this, I would like to share one more information. Dear members, whatever the audit you are doing, attestation function you are doing, I was in disciplinary committee for 4 years, 1 year as a presiding officer also, and 3 years I was the chairman of the auditing and assurance standard board. The amount of importance of auditing standard in your attestation function is most important thing. I request the branch to, because in the auditing standard board, we are having a scheme to conduct the programs by the branches, by the institute. You can contact the present chairman or the secretary of the auditing standard board of the institute also, which play a very vital role. You want to learn auditing standard on your own, in our institute website, e-learning platform, nearly all the auditing standards are in video lectures by the experts. It is available. At your convenience, you can learn. After learning, you want to test your knowledge. Nearly 1,200 MCQ questions are there, which is also welcome. More than you, your CA final students, the young chartered accountant who want to come for audit, which is more helpful to you. You can utilize the advantage of the institute side, which has provided such a great facility, free of cost, at your doorstep to learn at your convenience. So I thank the branch organizers to considering me as the chief guest on this interesting occasion, because the topic is more interesting, but the faculty, then I won't say faculty, my colleague, because between me and TG Suresh, maybe the experience, 3-4 years of age and experience difference will be there. But he is the faculty experience wise, he is the senior most faculty than me in the tax field. So I don't want to open the topic. It is the most interesting topic. I don't want to open that area. So you are having a very right person for the right topic. So the branch participants and everyone can enjoy the topic. Thank you for the great opportunity. I wish the branch and the study circle all the best on all your endeavors. Thank you, Vet. Thank you.
Thank you,
Thank
sir.
you, sir.
It was really, really enlightening, sir. And sharing your experience, it's really of help in a place where we are practicing. So thank you, sir. Thank you.
Thank you, sir. Thank you very much for accepting our invitation. And today we are really very lucky to have you as our chief guest. I think your speech might have listened by few people. Whenever we say in Mopsil area that for GST returns, for 9C, for notices, we should charge separately like that. Some people will say that it is not what we call E-Seva Kendram or like that, but to charge for everything. Annually, we take some 5,000, 10,000, like bonded labor. From 1st April to 31st March, 5,000, 10,000 we will charge. Notices reply in that only, 99C in that only, filing of GST returns in that only, everything in that only. Even yesterday also I have spoken to 1 or 2 people. I have told them, sir, please charge for 99C separately, for returns separately. Whenever they receive notices, at least a small amount, let us charge something, so that at least we can cope up with our expenditure. Day to day, our expenditure is also increasing. Moreover, our employees turnover is very high, because we are not paying good amounts or salaries to the employees. If we pay good amounts to employees, see, experienced staff will be with us, so that our burden will come down. Please let us do like this, sir. Then when other guy said, no, Ravi Kumar, where it is possible, who will listen? Like that, everybody used to say like that, sir. But today, I think your speech might have opened their eyes, sir.
Ravi Kumar ji, with your permission, all the organizers, I will tap 2 information for our chartered accountants. Because you said about 9C, with the permission of the speaker also, TG Suresh, I will take few minutes. Okay. Your time is running out. I know that for your topic. 2 things.
Sir.
2 things learned from your customers. Customers are business people. If you are having a back pain, most of us will have a back pain.
I'm having, sir.
We could have gone to the physiotherapist.
Yes.
The physiotherapist will give you a heating pad machine as well as the heating machine. Some therapy he will give.
Yes.
The cost of the machine is only 20,000 rupees. Every 20 minutes, he will charge 150 to 200 rupees, depends on the place.
Yes.
Same machine, he will not give the treatment. A +2 failed student person will give the treatment in the therapy center. Same 20 minutes, same backside, same machine. But he know how to charge for the same activity separately. Another interesting thing I would like to share is my personal experience. One fine morning, along with my son, I went to a hotel for breakfast. It was happened 6-7 years back. I ordered for idli. My son ordered for rava dosa. It has happened. So for idli, they given 3 varieties of chutney, and the idli they given that what is the called chili powder. For my son, for rava dosa, they given 2-3 color chutney and sambar, no chili powder. But my son will like the chili powder. So immediately, I also like chili powder. Immediately, he's taken my cup of chili powder for me. Then I told, don't worry, so Dad, I will take. Okay. Then I called the waiter, you give me a small cup of chili powder. He came and gave me a small cup of chili powder for me. The bill came. The bill came. That hotel is our client only, some auditor's client. Idli this much, rava dosa this much, coffee this much, extra chili powder. Who is that person who doesn't know activity-based costing? That's what TG Suresh will teach. That's the reason I don't want to tell ABC. Activity-based costing. So you learn activity-based charging. If you are charging, if you are doing any service, that means you are not valuing your knowledge and time. He may be 100 years old client, but you are investing your time, your knowledge for his compliance. For his compliance. So this is my advice. Our business community know what to do. But we are advising the business. Chartered accountants are doing business of businesses because we are advising the business people. But we don't know how to do our own profession. Then we should not blame the system. The last point for you. IAS officer in Warangal or Karimnagar or Hyderabad getting same salary. Horlicks price in Warangal or Karimnagar or Hyderabad, same price. Capital gain, whether earned in Warangal or Karimnagar or Nizamabad, same rate of tax. If you are charging less price than the city value, you are undervaluing yourself. If you are not willing to rise, institute is not the problem, individuals are the problem. Profession is not the problem, institute is not the problem. The individual who are taking the decisions are having their own problem. Come out of that inferiority feelings. This is my suggestion.
We are
With the
feeling
permission
more
of
insecure.
sir,
Our
with the
people-
permission of the organizers, in the presence of my good friend Shekhar, I would like to take 2-3 minutes. So one reason why all of us are afraid of charging the fees or thing, they fear their so-called fear of competition. Me and Shekhar were taking in the same premises. I am in the ground floor and the first floor. So both of us used to have the crowd. So therefore, there is nothing called competition. Let's understand. In fact, so both of us used to enjoy the presence of each person. And I can recall, I went to the puja of Shekhar. In fact, I was the only
Yes,
other person.
inaugurated. He only inaugurated my building, first founding stone.
So therefore, there is no need to have a fear. There's nothing called. We can always collaborate. In fact, I can proudly say, if at all I charge a fees which is more, it's only because Shekhar, he is the person who was the first person used to say in Bombay they're charging 10,000. Suresh, what all of us are doing. And in fact, he said we are undervaluing grossly. We should provide facility. I remember that discussion. He said we are shouting like this. We are spending so much time leaving the family. We are charging 100 rupees, 200 rupees, 300 rupees a fees. At least we should move to 4 digits. And he had the courage and guts at that point of time to move. And I think if at all, I would say the teaching profession Chennai had a start. I think it's because of the guts, this thing, the amount of time spent, he introduced a lot of things like from books, I think. Yeah, it's not that increase of fees alone. It's the amount of facility provided, which is a benchmark at that point of time. I think I must also say all of us were thinking like what you were saying, that old age, 30 years, 20 years, we're taking all those things and we continue to enjoy it. So therefore, there is no need to this thing. And he lives by what he says. That's what I'm saying. So therefore, and there is nothing called, as I said, I went to his puja and I inaugurated. I think there is no need. There is, as he rightly said, so the client is something where we should not hold on. As the Krishna used to say in Bhagavad Gita, there is nothing to hold on, right? At the end of the day, if the client is not able to value what you do, I think let him go. I think we should let him go. So I think if definitely he lived up by what he said. That is what I just want to, and we shared. That's why I told, I thank all the organizers because after a long time, because in the last
And 9 years he was in the council. Every day we used to have good morning, good evening every day. That was missed because, of course, he could not take the classes, which is, of course, the students are the biggest losers. But 9 years he has to travel immediately. In fact, he was asking, is it possible? He said, the amount of travel I make, I don't want to do injustice. I don't want to cancel the classes. Because you know that I come from Mylapore, it's hardly half a kilometer. He used to travel 8 kilometers. And in most of the classes, they will be 10 minutes before me. Of course, I had the privilege of starting at 6:10 for 6:15 classes. But they used to start at 5 o'clock. I've never seen. In fact, we used to chat between 6:05 to 6:10 before going to the respective classes. The same premises, ground floor, first floor. For a lot of time, they have to go inside. Before the due to disturbance, we requested to have separate steps. Before that, in my classroom alone, the students will go. So he enjoyed that. That's what I'm saying. So it's been a great moment for us, and both of us, all the institution and surroundings. In fact, he was pricing about this thing. He mentored Saravana Prasad to get All India first rank, and he's one of the fascinating costing teachers maybe India has ever produced. And I think, and every day Saravana Prasad you always used to really credit Shekhar for that, and there is no doubt. So that's the kind of these things he has made the impact. And the most important point, as I said, coming from a district, small district, there isn't called small or big. I think that's where Shekhar's inspiration will always come, because a place is not the criteria and all those things. At the end of the day, the kind of vision, other things you have, I think definitely, I'm very, very happy to share with my good friend. And I think I must thank the organizers for that. In fact, we had a long chat in the morning after a long time. But for this program, I don't think that would be possible. So thank you, Shekhar, for wonderful, kind words that have been so inspirational coming from that particular remote place. It's a very small village I was talking about. It's a very small village, not even like a Madurai at Trichy. It's even smaller than that. So hailing from that, I think he has definitely set the tone. So there is nothing called small or big.
Yes, sir. Sir, I once again thank you, Shekhar sir, for accepting our request. Really, we are very happy, sir. Today, you have also opened the eyes of few members who do not agree with your views. Because of your speech, I think if there are some members who changes their charging method, fees charging method, that will be good for our profession and members. See, day and night we are sitting here and providing service to thousands of clients, charging very, very less and servicing to thousands of clients. Instead of servicing such type of service to the thousands of clients, we can serve to lesser number and charge more and have peace of mind. I think that is the theme of your advice and your good words. I once again thank you. Thank you very much, sir. Let us give a big hand to our chief guest today. Suresh.
Yes, sir.
Warangal
Thank
branch,
you.
Suresh.
Warangal branch. Sorry.
Started.
Yeah, please unmute your, please, I request all the members, please unmute.
Thank you, sir. Thank you, sir. All e-clapping, everything in e-clapping.
E-clapping.
E-Jyoti Prajwalana, all becomes electronic. Now I request, thank you, sir. Thank you for the chief guest, today's chief guest. Now I request our Karimnagar Secretary Garu, CA Chiranjeevi Garu, to introduce today's eminent speaker, CA Suresh TG Garu. Over to you, sir. CA Chiranjeevi Garu, Secretary of Karimnagar branch.
Yeah, thank you, sir. Thank you very much. It gives me an immense pleasure to introduce today's speaker, TG Suresh Garu. He is a qualified chartered accountant in November 1988 and started practicing immediately. He is a pioneer in informing the firm Suresh and Balaji in 1990. Mr. Suresh has been instrumental setting up a strong internal control system for his various clients. He is also represented before assessing officer for high pitch assessments. He is also given opinions in wide ranging of issues in domestic and international taxation and various corporate clients. He is interviewed CA and CMA CS technical lines and placing them in various positions in accounting and financial positions. And he is also a leading faculty in Chennai for domestic taxation, international taxation, financial management, cost accounting, and financial accounting for last close to 30 years. He has been a pioneer and role model for thousands of students pursuing a chartered accountancy, cost and management accountancy, and corporate secretaryship courses. He is also visiting faculty for taxation at the regional councils of ICAI at Chennai, Bangalore, Mysore, Ernakulam, and Cuttack. Many of students fondly called him as CGS instead of TGS, though many of students called as a CGS as mentioned by Shekhar sir. Thank you, sir. Thank you very much for this exemplary discussion on capital gains. And he has been a regular faculty for RTA Chennai, which conducts a training of income tax officials. And he is also author or paper presenter on publishing articles in online as well as in offline. He is also authored some books, accommodation and professionals. His academic and professional titles like direct tax laws and capital gains tax, law and practice published by LexisNexis. And he is presented on various seminars on taxation, both professional and industrial bodies. To name few, the ICI, TA Study Circle, Society of Auditors, and NASCOM, and Madras Chamber of Commerce, Andhra Chamber of Commerce, and Hindustan Chamber of Commerce. Currently is the chairman of International Fiscal Association, SRC Netherlands-based NGO, and currently co-chairman for Direct Tax Committee of SICCI, Southern India Chamber of Commerce and Industry, and is a regular member of direct tax committees formed by professional bodies, trade association, and farm suggestion. So these are all the small jewels in his crown. So with this small introduction, I would like to introduce TG Suresh Garu, a renowned faculty for taxation and all. Thank you, sir. Thank you very much. And over to you, sir.
Thank you, A. Chiranjeevi Garu. Now I request today's eminent speaker, CA TG Suresh Garu, to start.
So thank you. So I sincere thanks to the organizers for inviting me, and also more importantly, connecting back to my friend after quite some time. So in fact, that was the most happiest moment in the morning. So so today you see the topic was it's a combination. So it's a JDA and important issues. So before I go to the JDA, we have some slight limited time or 20 days to go for one very interesting planning, because in this Finance Act, they made this amendment which is due for quite some time. So therefore, so before I go to the discussion on the JDA related income tax perspective, so I'll touch base on few things for which you have another 20 days for you to plan. As we talk about 50-40C type is one way of planning. There's a slight aggressive planning which we can just think of. I'm just want to start off this for the simple reason you are left out with another 20 odd days, and some of them are coming up on even day before, the day after tomorrow on Monday. You have some good opportunities in this regard. The Finance Bill 2022 is trying to plug this loophole. So therefore, I will start off with these are my agendas for today. So first, we'll talk about from the important issues and capital gains part of it. The bonus tipping to reduce the capital gains tax. I want to take the second issue on the sale of residential house land property, because that will set the tone for the JDA from a tax perspective. So exemption for more than one residential, the implications of amendment in assessment year 2015-16. So what it will have an impact on the JDS perspective also. So I just try to just set the platform from this second issue and third issue before we go to the bigger topic of JDA. In fact, one particular 2 years, both for the department as well as in various forums, I was talking only about JD. In fact, I had my own doubt. People will start calling me JD Suresh. So to that extent, I had the thing. But with a limited time, I'll try to do justice for the same. So first, we will, the way in which I want to take this discussion for the next 1.5 hours. So we'll take up a case study for each issue. Just for the benefit of all of us, we'll go through the relevant provisions of the Act. highlight the portions which are resulting in the issue, and we'll try to make some possible conclusions based on the discussion. So this is how I want to approach today's session. So ahead of the JDA, I'm just trying to take up this when you are fresh this issue, sir, because when we try to do this towards the end of the program, sometimes it might be slightly difficult to understand. So therefore, with the limited time frame available, I just thought I should first start off this and then of course take the JDA part of it. So how to use the bonus shares as a way to reduce or avoid capital gains. So the very important point which I want to bring to, due to the proposal by the Finance Bill 2022, you have only 21 days available for planning on this regard. So therefore, by 31st March, you have to do this. After that, you don't have a choice. Now, just to start up with the discussion in terms of a small case study to understand the whole issue. So there was a sale of vacant land which results in a short-term capital gains of 500 lakhs. Because SSC also had a short-term capital, a salary of 300 lakhs. As Shekharji was mentioning, apart from capital gains, he also had other income, and you talk about the surcharge, talk about the cess. Now, the tax payable after considering the surcharge at the rate of 37% and the cess of 4% is effectively close to 43%. So that means you have to pay on the 5 crores of capital gains close to 2.13 crores, 2.14 crores. Of course, the consultant who is trying to give an advice says that this is a short-term capital gain, so you don't have REC bonds or buying another house and all this stuff. So he gives you limited options. So that's the context which you are trying to set as what we are planning. As I told you, you have just another 21 days available for this. So basically, section 94.7 and 94.8 are popularly called as a dividend stripping or bonus stripping. Now, I don't want to go deep into 94.7, but I just want to bring it to your attention first to 94.7, because any person buys or acquires any securities or units. Now, if you closely look at the section, which is very interesting and very important. In 94.7, what they use is securities or units. I don't want to get into 94.7 because it's not intention. But for a comparison purposes, I want to use 94.7, which is basically very popularly called as a dividend stripping. After the removal of exemption into 1034 and 1035 for dividends and income from mutual funds, 94.7 has lost its relevance. I don't think 94.7 can be used anymore, because in order to apply 94.7, the dividend must be exempt from tax. So since that is not the case, for all practical purposes, we can conclude 94.7 has lost its relevance. But if you go to 94.8, as it stands before the amendment to the finance bill, if any person buys or acquires any units, so if any person buys or acquires any units, if you just compare this with 94.7, if any person buys or acquires any securities or units. So therefore, if you closely watch out for the sections, you can observe that the provisions of 94.7, which is meant for dividend stripping, is applicable both for shares as well as for the units. So whereas when you come to 94.8, before the amendment been made by the finance bill, which is yet to be passed, any person buys or acquires any units. So that means the provisions of 94.8 relating to bonus stripping is not applicable for shares till assessment year 22-23. So it's applicable. They made a change. They widened the scope of 94.8 from assessment year 23-24. But till 22-23, you find any person buys or acquires any units within a period of 3 months prior to the record date. Such person is allotted additional units without any payment on the basis of holding such units. Just to simplify that wordings. So you buy original units, you get bonus units. Obviously, after the issue of bonus, the value will come down. If it is going to be 1:1, the price is going to come by half. So what this section is you sell your original, but retain your bonus. Then the loss which is going to arise to you on the original units will be ignored and will be added to the cost of acquisition. Now, what does it mean? Say possibly in accounting standard 13, the cost of the bonus units is calculated differently. But whereas in income tax, if you recall, section 55(2)AA of the Income Tax Act specifically provides the cost of original will be original cost and the cost of bonus will be 0. So if I buy an original shares for 100, after the bonus, if it is 1 is going to come to 50. But as far as the income tax is concerned, for the original, the cost remains as 100. For the bonus, we are going to take the cost as 0. So the 94(8) was apparently introduced to prevent the misuse of planning through bonus. But surprisingly, the wording used in the section is any units. So therefore, till assessment date 22-23, 94(8) does not apply for shares. So therefore, it just gives us an opportunity till 31st of March to use the concept of bonus. How does it work? Let's assume the original shares are 1,000. After 1:1 bonus, the shares after the bonus recorded is over, the share price will come to 500. But the original shares will have a cost of 1,000. Bonus shares will have a cost of 0. But the price after the record date will fall to 500. So that means if you're going to sell your original shares, you are going to get a loss of 500 per share, which is a short-term capital loss. As all of you are aware of, the short-term capital loss is available to set off with both short-term as well as long-term capital gains. Have you really lost anything? The answer is no, because that 500 rupees, which is a loss, which is notional, that is what you have by way of a bonus shares, for which you already have a value of 500. So this is the way in which high net worth individuals used to plan their taxation to reduce the tax. So now most of us will think about, should we have to have 50 lakhs of RAC bonds one financial year? If you consciously invest in that, of course, that may be preferable for people who are above 50 years or above 55 years when the risk-taking ability has come down, because it's very safe. But purely from a financial management point of view, from a risk-return point of view, are they really these things? Honestly, I would consider from the point of return, which is very less. But from the point of view of risk, it is relatively less risky, or virtually you can say there is no risk, because these are all RAC bonds, NHA bonds, IFRC bonds, which are highly safe and secure. But only 50 lakhs of cap is there, plus the return is close to only 5%, which may not be a significant return, but for saving the tax, you don't get much. So that is where high net worth individuals used to plan or reduce the tax by the concept called bonus stripping, using the loophole in section 94(8), which was made applicable only for units and not for shares, unlike 94(7), which is dividend stripping, which is applicable for both shares as well as units. So just to illustrate this particular point, so what are the implications of this? Loss on purchase and sale of original units will be ignored. The loss so ignored shall be deemed to be the cost of acquisition of bonus units. So let us compare the two sections, 94(7) versus 94(8). This deals with dividend stripping. 94(8) deals with bonus stripping. 7 will apply for both shares and units. 8 will apply only for units up to 31st March 2022. Of course, the scope has been widened from assessment in 23-24. Of course, the dividend stripping has lost its significance consequent to the removal of exemption under 1034 and 1035. Therefore, we can say for all practical purposes, 94(7) has limited use, whereas 94(8) has now become a very, very prominent section from the next assessment year. Just gives us another 20 odd days for us to plan or reduce the tax as suggested by the chief guest. Not only you make use of the section, at the same time, so also get yourself adequately rewarded, and also at the same time, give the warning. As always, investment in share market, considering the current geopolitical tensions, are always going to be something which is going to be riskier, and the client has to be aware of the risk involved. But having said this, I will show a few examples. It is not necessary it must be that riskier. Take one practical example. HCL announced a bonus issue on 23rd October 2019. Announcement date is 23rd October 2019, and ex-bonus date is 5th December 2019. So therefore, you had a good amount of window. So we have 8 days in October, 30 days in November, and then 4 days in December for us to really plan. The ratio is 1:1. Now let us look at the prices of HCL website on the various dates. I have not taken the prices of slightly moreover in this range, therefore not altered this point. So 23rd October 2019, opening price is 1070, highest price is 1104, and low price is 1068. Previous close is 1064. The last traded price on that day was 1102. So we'll take, for the sake of simplicity, you purchase the shares on 23rd October at 1100. Now 5th December 2019, why I've taken 5th December? That is the record date. So obviously because of 1:1, the price will roughly come by half. So the previous close is 1125, and that's why the last traded price was around 561. So it is approximately 1:1 bonus, therefore the price has fallen. Now, the price as on 18th February is more or less same. Today's approximately it is in the same range as we are on 11th of March. So therefore, since there is no significant change, but just only for illustrative purposes, the last traded price on that day was 1165. So just we'll take some numbers for easy understanding. So we took in the example, there was a capital gains of 500 crores, or 5 crores rather. Assume somebody purchases 18,285 shares at the rate of 1120 per share on 23rd of October. So on 5th December, being the record date, you would have got another 18,285 shares. Now, if he sells the shares which he purchased on 23rd October at 560, being the price on 5th of October, he would have effectively got a loss of 560 rupees per share. How? 55(2)(a) specifically provides the cost of acquisition of original shares will be the original cost. The cost of acquisition of bonus shares will be considered as 0. Now, as per 55(2)(a), which was amended from assessment in 95-96 and also 96-97, 2 years they made a change, because prior to that, we used to apply the decision of Supreme Court in Dalmia investment. So as Shekharji was talking about, every amendment, every charging section is as a result of the decision of the Supreme Court. This also had a decision of the Supreme Court, which they need to change on account of a different reason. Bonus shares will have a 0 cost. Original shares will have original cost. Always the reason for them making this amendment is different. Always bear in mind, when one door is closed, there is going to be another door open. By making this amendment, what they was trying to do, they don't want to have the concept of average cost, which is the position of the accounting. Now, in this particular case, I would have got a loss of 5 crores on the sale of my original shares. I have a short-term capital gains on 500 lakhs. Now I'm going to have a short-term capital loss on sale of shares 500 lakhs. So my net taxable capital gains become 0. So I've saved the entire tax of 2.14 crores. Now, after this, I sell the bonus shares on 18th February 22 to 1165 per share. Sale consideration 1040, cost is 0. That is a long-term capital gains of 1040 lakhs. So, though if it is regularly be on 1039 lakhs, because in any case, you have 1 lakh of exemption for long-term capital gains. I'm not factoring that given this fact. The tax on bonus shares will come to approximately 124 lakhs. Now, if you look at what is your total gain in this particular case, So 89,285 shares you purchased 1,000 lakhs. 5th December sale value 500 lakhs. 18th February sale value 1,040 lakhs. The tax saved is 214 lakhs in 1920. Tax paid in 21-22 is 124 lakhs. The net gain 1,040 plus 500 plus 214 minus 124 minus 1,000. So that means effectively in about 2 years' time, so will be 6.3 crores is what you would have gained. We are talking about from 23rd October 2019 to 2022, in about 2.5 years. Effectively, he gets actually 6.3 crores after considering everything. Maybe people can always say that is it one half, but I think I'll also take you to like the case of TCS, May 2018. They had a 1:1 bonus issue of 800 rupees per share. Current market price is approximately 3,800 rupees per share. TCS, HCL, all of them consistently also declare dividends. We have not factored the dividends which should have been received by the SSC during this particular period. We are talking about around 3.5 years. Infosys in October 2014 gives a 1:1, another 1:1 in 2015, and now the current market price is not 1,700. In fact, since this it has gone up by another 100 odd rupees. So you had multiple bonus issues given, and you can make your own calculation in terms of how much the SSC would have actually gained on this. The only thing is, so the amount of the gain which the SSC has made is going to be phenomenal. So now the point which some people might raise, we are presuming always the price will go up, all the stuff. Hey, you have all the shares which I listed are also trading in F&O. So definitely F&O shares are subject to hedging also is possible. And at the end of the day, these are all the kind of risk which you have to take. But I've not seen somebody losing in TCS or HCL or Infosys for quite some time. And these are all individual choices. What I'm here to bring about is not about whether to invest, not invest, and all the stuff. I already have a disclaimer, the next page. My idea is this is one area which I found many professionals have not considered at all. So we are only thinking about buying another house, buying an REC bond, NFA bond. Most chartered accountants have not thought beyond the REC bonds or buying another residential house. So that is my experience. That is why I just want to bring, with this window getting closed in about 21 days time. So something which you can explore, of course, subject to the normal disclaimers. After all, we know as an auditor have to give a disclaimer report. So now these are some upcoming bonus issues. So we have 5 bonus issues coming up. So on 14th March, 1:1 Infibeam Avenues, which is just like your a slightly lower end version of maybe you can say it's another technology company, because these tech companies do have their own pluses and minuses. So we have 15th March Brightcom Group Company, one of the very famous investor, Shankar Sharma, is investing pretty hugely in this company. 21st March, virtually the Bombay Stock Exchange, we all know with the prevailing situation in National Stock Exchange, NSE coming out with an IPO near future is not there at all. So this BSE India in stock exchange is definitely one of the very prominent plays. The 2:1 bonus issue, which means definitely there is a huge scope available. 21st March, Vinci Limited, 1:1. 24th March, Nandan Denim, so 2:1. So these are some upcoming bonus issues which you can consider, especially companies like BSE India. Just a phenomenal run in the last 2 years. It's one of the top performing stock in India on account of the huge volume and so many retail investors participating. Definitely they're doing exceptionally well. It is not all recommendations. I'm only saying this all the available opportunities for you, which you ought to think. So that's why the disclaimer goes there. So investment in stock market subject to market risk. So due precaution care must be taken before investing. So these are the analysis based on the data available from NS and other websites. They're not recommendations, and these are only information purposes only. So I don't recommend any of these things. But so my experience with on discussion with many chart lawyers, Shekharji was mentioning, these are all. So in a similar situation, your office people are you spend 10 minutes. What it is? It's not about 10 minutes. It is a 35 years, 36 years, so many years of consistent reading of the subject. What we give in few minutes, but it is not an effort of few minutes. It is an effort of multiple years. So it is there. So unfortunately, until such time, we also, it's also about the perception, it's also about the packaging, as Shekharji was rightly pointing out. Sometimes our client also thinks if you give a solution, instantly he thinks that the issue is very small. So sometimes definitely given the data and other things self-explains itself. Not only the SSC is saved tax, they've also got a huge return. Of course, there are always two sides to the coin. There's always a risk involved. Of course, the risk is there in everything. At the end of the day, it's a question of you should use your financial knowledge and also the hedging methodologies to really protect from the losses. Whatever possible from our end, we can do it. There are a few questions which have come before. So maybe like, I don't know whether we'll have the time. And by the time we go to the last issue, I think people might also forget about this particular point. So therefore, so if time permits, I'll take the question later, but otherwise I will be available always. I'll share my email ID and mobile number so that we can always have an offline discussion if you need some clarity on this particular point. But I still believe that we have a good amount of 20 days for us to use this opportunity. I'll once again reiterate this concept of bonus stripping planning. It's no longer available from 1st of April 2022. So we've got another 21 days alone for us to plan about this. So this I will try to take as a platform for our discussion for the joint development agreement. This will be the first preamble because there are a few things which many of us miss out when it comes a question of in the joint development, because one is the understanding and two, what section at which you have to claim the exemption. Sometimes in a JDA it becomes very difficult. So therefore we need a slightly simple example before we go to the joint development and apply this also there. So there was one particular case where a residential house, the land upon there too was sold. The land was held for more than 24 months, but building was held for less than 24 months. The issue number one is whether the capital gain is short term or long term. And if the SSC purchases another residential house, whether the exemption is available under section 54 or 54F. So I purchase a land, construct a residential house there, sell the residential house. Unfortunately, the construction of the residential house was completed at the time of sale only within 2 years. I've sold the house, but the land is more than 12 months. Now, whether it is a short term or long term, obviously the department's point is simple because if both are long term, we show it as a sale of residential house, claim exemption to 54. When land is long term and building is short term, should I have to take the capital gains as short term? Because that's what the department feels. Because what you're sold as a residential house, and therefore the entire capital gain should be offered as a short term. His contention is very simple because when both are long term, you say it is only a sale of house and claim exemption to 54. And therefore, when you are building a residential building is short term, the entire capital gain should be offered only as a short term. So, should the entire capital gains be considered as long term? Should the entire capital gains be considered as short term? Or can I take land as a long term and my house as a short term? That's the first issue. The next issue is that if I reinvested in another residential house, will I get exemption at 54 or 54F? Now, interestingly, the Madras High Court in DL Ramachandra Rao took a stand that when your land is more than 24 months and building is less than 24 months. The land can be taken as long term and the residential house can be taken as a short term, even if the consideration is composite, which was the objection of the income tax department. Had the consideration been split into land and building, we would not have a problem. But since the SEC is taking as a composite consideration, they said this will not accept. But for which the Madras High Court suggested we can take the split according to the stamp valuation, because for the purpose of stamp duty, you have to bifurcate. So we can use that bifurcation for the land and building. And interestingly, the judge who delivered the judgment lives just the next building. There is only one wall separates between me and the judge because he's no more. But I had the privilege of seeing from my window, his window, one door. He is the judge who resided in my case, Mr. N.V. Balasubramanian, who was residing in my next door. So one interesting point here was the assessor's contention, or the the department's contention was thrashed in this particular case because of an earlier decision of Supreme Court in a case called Abs Theatre, where the assessor claimed depreciation on a theatre building, including the cost of the land. And the assessor made a beautiful argument that after the construction of the theatre in the land does not exist. But the Supreme Court judges made a beautiful point. If you want to see your land, demolish your theatre, you will find the land. So the Supreme Court made a beautiful observation. The land as a separate independent asset does not cease to exist even after the superstructure. So mere construction of superstructure does not make your land not exist. It is still there, is invisible, but it as a separate asset continues. This was strongly relied upon by the Madras High Court, which set the tone in D.L. Ramachandra, followed by many decisions. Umpty number of decisions are there. That if your building is short term, land is long term, you can always bifurcate the capital gains into land, long term, building, short term. Even if the consideration is composite, you can use this stamp valuation bifurcation as the basis. The next issue is that having bifurcated the capital gains as land, long term, and building, short term, the reinvestment into residential house, will it give me exemption under section 54 or 54F? Just for the benefit of all of us, we'll just try to take one example and then go to the relevant portion section as I promised. A vacant land was purchased on 1/4/2019. The residential house is constructed on the same. The construction of the residential house is completed on 1st July 2020. Residential house is sold on 1st June 2021 for a composite consideration of 100 lakhs. New residential house was purchased out of the sale process. Is the capital gain short term, long term? Whether the SEC claimed exemption to 54 or 54F. For the reasons which we already discussed, the land will be considered as a long term. Residential house, the building will be considered as a short term. The bifurcation used for the purpose of payment of stamp duty will be used for bifurcating this 100 lakhs into land and building. But the issue now is the reinvestment into the residential house will make me eligible for the exemption to 54 or 54F. So just to recall the provisions of 54 and 54F, this is the relevant portions of 54F for the benefit of all of us. I've just reproduced the section. Subject to the provisions of subsection 4, where in the case of an assessee being an individual or a Hindu undivided family, the capital gains arises from the transfer of any long-term capital asset, not being a residential house. So if you just look at 54F, now this is the relevant wordings which is relevant for us. Now, in order to claim exemption under 54F, I must be an individual or HUF. The capital gains must arise on transfer of long-term capital asset. The next line is very important, not being a residential house. It's very important for us to understand in our example. I purchased a vacant land. On that, I've constructed a residential house. And the residential house is what I've sold. So in order to apply section 54F, the asset must be a long-term asset, not being a residential house. So what I've sold here is only a residential house. Therefore, I'm not eligible for 54F. Clearly there in the fourth line of the section. I must be an individual HUF. I must have a capital gain from long-term capital asset, and that long-term capital should not be a residential house. Now, since what I've sold is a residential house, I'm not eligible for exemption under 54F. Logically, therefore, the question which comes, will I be eligible for exemption under 54? Now, if you go to 54, I've just reproduced a section for our easy understanding. Subject to the provisions of subsection 2, where in case of a necessity, being an individual or a Hindu undivided family, the capital gains arises from transfer of a long-term capital asset, being the buildings or the lands pertinent thereto, and being a residential house, the income of which is chargeable tax under high HP. So you have a lot of jargons here. First, I must be an individual or HUF. The capital gain should arise from transfer of a long-term capital asset. That long-term capital asset has to be buildings or lands upon thereto, and it must also be a residential house. Now, the income of which is chargeable tax under high HP. We'll go from the back. Whether the income from the property is taxed under high HP, even if the property is self-occupied later, it will have been taxed under high HP. Check the checkbox, tick. Go to the previous point. It must be a residential house. Yes, I've sold a residential house. Go to the previous one. It must be buildings or lands pertinent thereto. I've sold building as well as the lands upon thereto. That is also satisfied. Go to the previous one. It must be a long-term capital asset. Now, here the important question. As far as the long-term capital asset part of it concerned, for building, it is not long-term. But for the lands appurtenant thereto, it is long-term. So therefore, though for building component of it, I'm not going to be eligible for exemption because it is not a long-term capital. I lose that condition. But for the lands appurtenant thereto, which is the buildings, that is only long-term as per the decision of Madras High Court, D.L. Ramachandra Rao. So therefore, what is very important, with due respect to the Institute suggests answers, even for such question, Institute suggests answer puts the exemption only into 54F, which is incorrect. The exemption is available under 54. Now, what is the advantage? Why I'm fascinated with 54? Why I'm obsessed with 54? If it is 54, I have to invest only the capital gains. In 54, I have no restrictions at all. I can own any number of houses. That's not a problem. So if I also reinvest also, I can reinvest in any number of houses. The only question is whether the exemption is available for all or one is the issue. There is no restriction on the number of houses I can purchase. But if I'm going to be eligible for 54F, I should not own more than one house. I should not purchase more than one house. I should not construct more than one house. And I have to, more than anything else, I have to put the net consideration. I don't have to put the capital gains. I have to put the net consideration. Therefore, the conditions for availing and the amount required to claim exemption to 54F are larger. The conditions are more. Therefore, between 54 and 54F, I will always prefer a 54 to 54F. So now the question obviously will come. Yes, sir, all your arguments are fine. So do you have any case laws to support? The answer is yes. So these are the cases relating to the land does not lose its separate identity ever after the superstructure. The consideration is composite, then bifurcation adopted for a stamp valuation can be used. T.L. Ramachandra Rao, as I already told you, Madras High Court, my neighbor delivered the judgment. You have plenty of cases. You have Kerala, you have Calcutta, you have Karnataka. So many decisions as far as the land separation part of it concerned. The only question is the eligibility for exemption. Is it 54 or 54F? There I have a Karnataka High Court judgment, beautiful judgment. The land is long-term, building is short-term. And so long as the building is a residential building, exemption is going to be available only under 54 and not under 54F. Because all the conditions of 54 is what is satisfied and not 54F. Now, this is a very, very important judgment from the point of view of a joint development. That is why I just want to take up this particular point. Ahead of the tax issues relating to JDA, this is something which we're going to effectively use in a joint development agreement cases. So very important case in my view, more than anything else. It's something where in a JDA, this Anantaram judgment, Ramachandra judgment, all of them will be of a lot of help. So that's why I just want to take up. Before I go to the issues relating to the joint development agreement. So even Shekharji was also mentioning about the TJS, CJS comparison. So I think this was my second program. So this was the issue which I've taken up just for the sake of, since it has come to the discussion today to a larger extent. So therefore, why the name of CJ, which is attributable to the past president of ICA, one of the very, very famous, renowned, adored teachers of income tax, Mr. T.N. Manogaran. So it was the second program of my program long back. This was the issue I was taking at that point of time. If you look at 54.2, this is 54.2. I just want to read from this part of it. The amount of capital gains which is not appropriated by the SSC towards the purchase of the new asset made within 1 year before the date on which the transfer of original asset took place, or which is not utilized by him for the purchase or construct new asset before the date of furnishing of written off income, the 139, shall be deposited by him before furnishing such return. And such deposit being made in any case not later than the due date applicable in the case of SSC for furnishing the return of income under 139.1. So basically, what 54.2 or 54F4 is trying to say, if you could not purchase before filing your tax returns, then you deposit in the capital gains account scheme, and only from the capital gains account scheme you can purchase or construct. And if you're not able to do before the time allowed to you for investment, whatever amount which you have not utilized will be taken as your deemed capital gains after the expiry of 3 years. That is basically the substance of the section. You all know there is a capital gains account scheme of 1988. I, as an article, still remember when this capital gains account scheme was not there. Those days, there is no computer and all. We used to type the ITR computation and all. So when the SSC is not able to purchase before filing date, so what we used to do is we used to claim the exemption and then put a small note. A time limit for investment is still there. SSC will invest in due course, and a proof of investment will be furnished or submitted to your office as and when it is done. And therefore, we claim the exemption. But in most cases, a lot of people have not actually utilized, though they said they will use. Most of the time, they have not used it. And if your 147 time limit is crossed, unfortunately, the department hands are tied. So this is one very important reason why they introduced the concept of deposit scheme. It's not sufficient to have an intention. Show that intention by way of putting in the capital gains account scheme in a public sector bank, not being a rural branch. So you have to deposit in the public sector bank in a separate account called capital gains account scheme. From there, you can use for purchase construction. This deposit you have to make when was an issue. So there are two parts of the section. If you look at the fourth line, the amount which is not utilized for purchase or construction of the new asset before the date of furnishing of written off income under 139 shall be deposited before furnishing such return. Such deposit be made in any case not later than the due date applicable to the SSC for furnishing the written off income under subsection 1. So here we have 139. Fourth and fifth line. When we come to the seventh or eighth line, then it talks about 139.1. So therefore, when I was speaking on this particular section, I was saying, in case if you are not able to purchase before you file the tax returns, don't file the tax returns, hold the returns, make the investment, and then file the return. Because the requirement to go to the deposit scheme, if you closely read this section, which is not utilized by him for purchase or construction of new asset before the date of furnishing of written off income under 139, there is no subsection there. When you move to the seventh or eighth line, shall be deposited by him before furnishing such return. Such deposit being made in any case not later than the due date applicable for the SSC for furnishing written off income under 139.1. Subsection is missing in the fifth line. Subsection 1 is there only in the eighth line. So therefore, what I was arguing at that point of time was So if you decide to purchase, not to go for deposit, you have time till 139.4 or 139.5 also. But if you want to go to the deposit route, you have to deposit by 139.1 due date. So therefore, there is a clear distinction drawn in line number 5 versus line number 8, which many of the senior chartered accountants present in the program disagreed with me. They said, Suresh, we have to read. You are an youngster. I was an youngster at that point of time. So you have to be careful here. You should read the 8th line along with the 5th line. That means the 139.1, which is there in the 8th line, has to be read with the 5th line 139. Therefore, the purchase or construction should also be done before 139.1. Deposit should also be done 139.1. You can't read line number 5, line number 8 separately. They have to be read together. At that point of time, Mr. T. N. Manogaran intervened and said to all the senior members present there, I think I agree with Suresh. I think what is interpreted is right. So in my view also, that option is available. But this particular discussion alone, from today onwards, we can call him a CGS instead of TGS. That's why whole concept came as to why, because today this came in discussion for a couple of times. So that's why I just want to mention. But couple of interesting developments in this case. This I'm talking about in the early 90s. A couple of developments which I'm talking about. A lot of courts have held that you can deposit even after the due date. In fact, they are reading the other way around. They read the 5th line, 8th line. What many of my seniors at that point of time told me, you have to read 8th line along with the 5th line. But now, what the courts, Punjab and Haryana High Court has held, that your 5th line and 8th line you read together. Even you can deposit after the due date. Capital gains account scheme. They said that you have to read 8th and 5th mix. You can also use 139.4 also. And of course, added to that, recently we have won a case before the Chennai bench of tribunal that even without deposit, if the assessee purchases, exemption cannot be denied. In fact, I myself won a case before the Chennai bench of tribunal. There is also Madras High Court judgment. There is also Karnataka High Court judgment. But even without deposit, if you purchase or construct also, unless you have diverted the money, you can always buy. So some very interesting developments, I thought, as to why this TJS comparison was brought in. So these are some my early days discussion on this particular point. So with this small preclude, in fact, before I come to the income tax, I just want to set this few. One is because of the recent amendment, and one, the previous judgment is going to be highly used in JDA. I will stick on only to the income tax perspective of this, given the fact that we're going to approximately have another 20 or 25 minutes. Because the topic itself is going to be more on income tax perspective. So therefore, I will not go into how to write the agreement to avoid this. We'll stick on to the consequences from the point of view of income tax perspective of joint development agreements. So basically, the implications is going to be strongly based on, as Chief Guest was also pointing about, the terms of JDA is very important. So therefore, the tax implications are going to be substantially dependent on how we have worded the JDA. Therefore, we have to be extremely careful about it. I will, though, not concerned about the wordings in today's discussion. What are the considerations which have stipulated? So what are the years? When will the transfer be deemed to be complete? And are you eligible for exemption of 54 or 54? That's why we had the previous issue also. So let us again, as we already suggested in all our issues so far, we have taken one number for an easy understanding. The property owner has got a 10,000 square feet. So the property owner is going to retain 5,000 square feet. Is going to give to the developer 5,000 square feet. So what he is going to get in return for giving the 5,000 square feet to the developer, he will get 4 houses. And developer will construct 4 houses and sell it outside. So basically, this is the issue which, for our understanding, for the rest of our discussion, keep. So 10,000 square feet of property available. It can be a land or it can be land with building. the builder, the developer can demolish and take it as land. So that is something which I want to bring it to your attention. So basically, a property owner continues to retain 5,000 square feet, and that is going to get 4 flats. The developer will construct 4 flats and sell it to outside. The property owner can either retain the 4 flats allotted to him, or he also in turn partly retain or sell, or he can sell the entire 4 flats. So basically, the consideration what he is going to get is the 4 flats for giving 5,000 square feet of land or land building. Total area 10,000 square feet. For if you are not comfortable with the picture, then 10,000 square feet. Developer will construct 8 flats in the above area. 4 flats will be given to the owner of the property along with the 5,000 square feet. 4 flats will be constructed. The remaining 5,000 will be sold to the developer. Property owner has got an option to either retain all the 4 or sell the flats allotted to him, or a combination of both. So what are the issues? So one, when will the capital gains arise? Is it the date of entering into the joint development agreement, on the date of handing over the possession, or on the receipt of flats? So how to compute the capital gains? Will the exemption be available in the 54 or 54F? So what will be the impact of the amendment in section 54 or 54 from assessment at 1516? As all of us will be aware of, from 1516, both 54 and 54F have been amended to specifically provide that you should purchase or construct one residential house in India. So if the property owner sells the flats allotted to him, how to compute the capital in such cases? So these are broadly the issues which we are going to consider in the remaining time available. So first, as we have been discussing, so we'll take you to the relevant provisions of the Income Tax Act for easy understanding, because always the reference to section helps us. Section 247 clause 5 is what is relevant in our discussion here. A transfer includes any transaction involving the allowing of the possession of any immovable property to be taken or retained in part performance of the contract of the nature referred to in section 53 of the Transfer of Property. So as per section 247(5), any transaction which involves the allowing of possession of any immovable property to be taken or retained in part performance of the contract of the nature referred to 53 of Transfer of Property. So what is very important? The transfer here is going to be based on the transaction involving the allowing of possession of any immovable property. So what is the transaction which is going to allow the possession of immovable property? Is the joint development agreement. That's what you must understand. The transaction which involves the allowing possession. What transaction is going to allow the possession of immovable property is the joint development agreement, which is going to give the builder or the developer the allowing of possession. So that is what is very crucial here. So the issue came before the Bombay High Court. Chhatrapati Dwarkadas Kapadia. It's one of the very famous decisions made by one of the all-time great judges, though unfortunately it's not with us, S.H. Kapadia. So he was the one who said after the amendment of section 247 clause 5, a transaction which involves allowing. So therefore, according to him, the date of entering into the joint development agreement will decide the transfer, not the date of possession. But some strange reason department takes the date of possession. So the date of entering to joint development agreement will be the transfer. Please understand, even after the introduction of 45(5)(a), the date of transfer has not changed. The date of transfer continues to be the date of JD alone. Even 45(5) becomes applicable to you. The transfer still remains same. 247 has not been amended at all. What was amended is only a new charging section 45(5)(a). So the decision of the Bombay Court, what will happen if it is invoked? There will be a problem where the assessee is going to get, assuming the consideration is only by way of constructed houses. So he is going to get after some time, maybe after 2 years or 3 years, he may not have the money or thing. What will happen is subsequently the joint development agreement fails and no construction could be done. The assessee is going to be at a severe loss. So this is the problem of the Bombay Court judgment. Subsequently, the Authority of Advanced Building also take the same listing in Jashi Singh Sarkaria. So there was one interesting decision from the Mumbai Tribunal, Geeta Devi Pasari, which was a very interesting case where the way in which the agreement was structured was such that the developer will more enter as a leave-in license agreement, and so therefore it was very carefully worded. But still, it's going to be very difficult for you to word to such an extent to apply the decision of the Mumbai bench. But there are some options available there. So subsequently, now the issue here is that I'm talking about the position before section 45(5)(b). So for property owner, he gets 4 flats in lieu of transferring 5,000 square feet of property. So essentially, he transfers 5,000 square feet of property for which he gets 4 constructed flats. So that means I'll get 4 flats for transferring 5,000 square feet of property. That could be a pure land, or it can be land with a superstructure in it. So you have to be very careful there that if it is a land, why it is very important is land in a residential house will be eligible for exemption to 54F. A house in house, you get exemption to 54. It is also, I found in, there's a very unfortunately in one particular case. So one assessee, what he did was, though it was only a residential building, before handing over to the developer, he demolished the building and then handed over the possession and entered a JDA with the developer. See, the problem here is that it was a residential building, but demolition was not done by the builder. Development was done by the land property owner. So therefore, when he handed over the possession to the builder, what he handed over is only land. So therefore, it became the transfer of land and not transfer of building. So once it is transfer of land, you are not going to be eligible for exemption under 54. Instead, you will come under 54. So therefore, a lot of nitty-gritties are there. That's what Shekharji was also mentioning, how you have to be very careful while drafting. But now, let us just for the sake of simplicity, which is 5,000 square feet, I handed over to the builder. In my area, builder is going to give me 4,004 flats. Now, the issue here, before we go into the 45(5)(a) implications, how to value that 4 flats? The value of the constructed area should be taken as the full value of consideration. But how do you take the value of the constructed area? Should I take the cost of construction? Should I take the guideline value? Should I take the fair market value being the amount charged to the builder? What amount I'm taking? So by and large, most of us followed the cost of construction as the full value of consideration. But however, in some of the cases, the assessing officer took a very strange stand. So what the assessing officer was saying, because understand the cost of construction is going to be on the date of JDA, right? But when the construction is complete after 3 years, the cost of construction will go up. In one particular case, the assessee sent notice to the builder, asked for his financials, and he was saying that the constructed cost of the building is this. Interestingly, what he did was, while arriving at the cost of construction of this building, he also attributed certain indirect expenses. He did not take the cost of this flat alone, because he was taking, apart from the cost, he was trying to impute certain indirect costs also to arrive at the cost. So likewise, some interesting aspects have been done by the department here. So therefore, it is always better you mention the cost of construction, though it may not be relevant given you have 45(5)(a) now. I'm talking about if you have already done, it should have been done earlier. So the cost of acquisition will be the cost of 5,000 square feet handed over to the developer. This I'm talking about 345(5)(a) position. So again, where the property owner is going to transfer the property consisting of residential house, you can take 54. Now the only issue is that when you get, if it is only land, you will get under 54F. Now the issue is whether exemption is going to be available for all the 4 or only one of them. So whether the amendment in 54 and 54F from assessment will change the position. So first, what you have to understand, if the house is demolished by the owner before the transfer or the property transfer is a vacant land, he can claim only 54F. But if he gives with building and the demolition is done by the builder, then there is no problem. You can take 54. The problem of 54F, we already explained in our early discussion also. You should not own more than one house. A lot of yard inverse net consideration. There are quite a lot of challenges are there. Now, so what if the property owner subsequently sells the allotted flat to him along with the land? Now, that is where I took the previous issue. When your land is long-term, building is short-term, how to compute the capital gains. The second point, will I get exemption to 54 or 54F for reinvestment? Look at, I already have the land. In my land, 4 flats are constructed to me. That constructed flats are immediately sell. So long as the land I continue to retain. So how to compute the capital gains here is a question. So what I've sold now, when I sell the new 4 flats allotted to me, I've sold the flats which is given to me. If I sell it immediately, obviously the building part of it is going to be short term. But the land I own much before that. So therefore, the land portion of it, I can continue to take the capital gains as long term. So therefore, if I buy another house, in such circumstances, as we already discussed in the decision of the Karnataka Nadantram, so I will get exemption only under section 54. If you already claimed exemption for the reinvestment, which you already made for the flats allotted, obviously the cost of acquisition is going to be reduced under exemption under section 54, provided this happens within a period of 3 years. So to quickly summarize before the introduction of 45.5, what was the position? First, take for the purposes of your computation of capital gains, the cost of construction of flats allotted to you will be taken as your full value of consideration, less the cost or index cost of acquisition of the land which was given to the developer. That is how you compute the capital gains. So 4 flats, depending upon whether it's 54 or 50 land or building, you can claim exemption under 54 or 54F. The amendment in assessment of 1516, in my view, will not have any impact in claiming exemption for all the 4, because the amendment came on account of the Karnataka court judgment in KG Rukmani Amma. See, the Karnataka, I got 4 flats given to me. So if I'm going to use all the 4 flats as one house, the Karnataka took a stand, even though he got 4 units. So long as it is going to be intended used as one, the exemption should be available for 4. Karnataka never said exemption, the air residential house in 54 should be in any number of houses. That's they never said. Sasi is having 4 houses, all of them are intended to be used as one. The exemption can be claimed for all the 4. And the position does not change even after the amendment in 54 and 54F, that A into 1 is not going to change. So long as you use all the 4 houses as one, then the position does not change. The amendment will have the effect of only, then you buy one house in Warangal, one house in Chennai, you can't claim exemption for both. So take even a Karnataka Andhra Pradesh High Court judgment. Assessee purchased 2 adjacent houses, removed the in-between wall, made them as one. Andhra Court exemptions available for 2. Though you purchased 2 houses, they were intended to be used as one. So therefore, the exemptions available for both. So therefore, I still don't think the amendment made from assessment of 1516, though litigative, may not have any impact so long as it is there in the same flats. It can be different blocks also, that's not a problem. But so long as they're the same premises, it shouldn't be a problem. Now, in fact, this 45.5a, so I can say that this was actually consequent to the Ishwar committee recommendations, where so I had an opportunity to also present before this particular committee. So this was a point which was touched upon, and a couple of issues were raised before the committee, that why you need a separate section for joint development agreement. though the suggestions were accepted partially, but one of the things which was a surprise to us, just beyond this, I don't want to talk about what happened in the discussion. Now, 45(5)(a) was introduced by Finance Act of 2017 from assessment in 1819. Starts with non-obstante clause, just notwithstanding anything contained in subsection 1. So where the capital gains arises from assessee being an individual or HUF. So therefore, 45(5)(a) is applicable only for individual HUF. It is not applicable for any other assessee. That means for any other assessee entering into a joint development agreement, it will be governed by only 45(1), not governed by the new provision. From the transfer of a capital asset being a land or building or boat under a specified agreement. So therefore, to apply 45(5)(a), it must be on account of a transfer of a land or building under a specified agreement. The specified agreement has been defined, which is there in the next slide. The capital gain shall be chargeable to income tax as the income of the previous year, in which the certificate of completion for the whole or part of the project is issued by the competent authority. So therefore, the first positive aspect about 45(5)(a), and compared to the erstwhile provisions, there, as per the Bombay Court judgment, the capital gains will arise on the date of entering into the joint development agreement, whereas after the introduction of 45(5)(a), the capital gains will arise only when the project completion certificate is obtained from the competent authority. So if it's a Chennai, the Chennai Metro Development Corporation, CMDA, should give an approval. Once that completion certificate is given, then the capital gains arises. So it's not going to arise on the date of JDA. It will arise only when the completion of the project is over, partially or totally. If we just recall our discussion, computation of capital gains, I said, is going to be based on the cost of construction of flats allotted to me. But whereas 45(5)(a) talks about the stamp duty value on the date of issue of certificate is going to be considered as a full value consideration. So they're defining what is the consideration, which was not there earlier. They're defining when the capital is taxable, which according to the Bombay Court was date of JDA. So the fourth bullet point is positive. Fifth one, I would say they could have done a little bit better. They could have said the cost of construction as certified by blah, blah, blah could have been the case rather than stamp duty value. But anyhow, that is a section we'll have to take it. When this section not going to be applicable, if the assessee transfers his share of the project on or before the date of issue of such certificate, then the section is not going to be applicable. So therefore, if I'm going to transfer my share of the project before the completion certificate is obtained, I can't use 45(5)(a). Similarly, if I'm not an assessee, if not an individual HF, I can't use 45(5)(a). So what is the specified agreement? The specified agreement means a registered agreement. So therefore, if your JDA is not registered, 45(5)(a) will not apply. Even many courts have held, but even the previous situation also not applicable. The agreement is not registered. So therefore, you need a registered agreement where a person owning a land or building agrees to allow another person to develop a real estate project on such land. The consideration of a share being land or building or both in such project, whether with or without payment or part of a consideration cash. That means unless you're going to get a share in the property, it can be cash plus property. It can be only property. But if you don't have a property, 45(5)(a) will not apply. Interestingly, the cash component will be subject to withholding tax under section 194(I)(c). The problem here is that you are going to offer the income for tax only when the project is completed. Whereas the withholding tax and cash component will take place in the first year itself. That means you have to defer the claim of TDS till such time you offer the capital gains for taxation. So, a summary of 45(5)(a), capital gains will arise only when the completion certificate is obtained. The stamp valuation will be the full value of consideration. The stamp value considered for the capital gains will be allowed as a cost if the flats allotted the property subsequently sold. That means whatever you have offered for tax at the time of allotment of flats due, and if you subsequently sell, that can be taken as a cost, obviously along with the cost of the land which is retained by you. So that will together will be taken as your cost. So a comparison of pre-45(5)(a) and post-45(5)(a), year of taxability, date of JDA or handing over the possession, as post-introduction of 45(5)(a), the date of project completion certificate. Cost of construction can be taken as full value of consideration. That is, stamp duty value is what you have to take. And if you sell the flats which are subsequently sold, the flat allotted to you, you can take the cost of the land retained by you plus cost of the construction of flats with the builder And here you can take your cost of the land plus the grade line value of the flats or the building, because that is what you're going to offer it for tax. So some interesting issues. Can you apply 45(5)(a) for JDA entered before 1/4/2017? It's a very tricky question. Should the section be applicable only for agreements entered on or after 1/4/2017? So my view is yes, it will apply only for agreements which entered 1/4/2017. Support can be relied upon. Amit Vishnu Pashankar Pune ITAD judgment specifically supports the view which I'm suggesting. Whether 45(5) will apply for JA not registered, as you have seen, the definition of specified agreement is very clear that the provisions of 45(5) will apply only if the JDA is registered. If it is not registered, it will not apply. So what will be the date of transfer of the capital asset after the introduction of 45(5)(a)? It's a very interesting point. So what you must understand, the definition of transfer in 247 has not been changed. Transfer definition of 247 continues to remain the same. But it's only 45(5)(a) is the charging section. So the charging section does not talk about when the transfer is complete. That is not been talked about. It only talks about when the capital gains arises. So when the transfer is complete, it's not dealt with by 45(5)(a) at all. So that means it is possible for the department to take a stand that the transfer is complete on the date of JDA. So what could be the potential fallout on account of that? We all know that the benefit of indexation is available on the basis of cost of acquisition into the index of year of transfer divided by the index of year of acquisition. The capital gains here is going to arise only when the project completion certificate is given. So that means capital gains will happen after 3 years. So let's assume I complete the property after 3 years, but date of JDA could be taken as a transfer. Therefore, the indexation could be available only up to the date of JDA. Similarly, one other challenge which we may have this regard, if the construction of the flats gets completed after 3 years, will I get the benefit of exemption of 54 and 54A? So in section, transfer is complete on the date of JDA. 54 and 54 exemptions available if I purchase or complete within a period of 3 years from the date of transfer. Now, if the construction gets completed, gets delayed, it's completed after 3 years, it is possible for the department to take a stand that your constructed flats which you got are not eligible for exemption of 54 or 54 if it is after 3 years. If you recall, for a similar situation in 45(2), the board has issued a specific circular stating that 45(2) is also where a capital asset is converted to stock in trade. Transfer is on the date of conversion, but capital gains will arise only when the stock in trade is sold. But the board has issued specific circular 791 dated 2nd June 2000. But the board has clarified that for the purpose of 54 or 54F or 54EC, 3 years will be taken from the date of sale of stock in trade. A similar clarification has not so far been issued in the case of 45(5)(a). Therefore, potentially it is possible for the department to take a stand. 247 continues to decide the date of transfer, and 3 years should be taken only from the date of JDA. The implication as a 45(5)(a) may not alter. Therefore, it is better for the department to clarify that the time limit will be reckoned differently, not from the date of JDA. But until such time, we have to prepare ourselves for the litigation. Can the reference to the valuation officer, is it possible? Becomes a very important question. Again, this is the reason for this. When you talk about, so essentially the question is whether 50C if can be subject to reference evaluation, because this charging section 45(5) specifically defines what is the full value of consideration. Can 50C supersede 45(5)(a) or 45(2) or 45(3)? Can 50C override the provisions of the charging section itself? That is where the question of reference to the valuation officer could be a challenge. Now, if the project is only part complete, because if we read 45(5)(a), it talks about a situation where with the project completion is certificate partly or fully, capital gains will apply. Now when the project is completed only partially, should the capital gains be proportionate or whether the entire capital gain should be offered for tax is the question. So my humble view is that the capital gains should be only proportionate. It cannot be full capital gains. So now it's 7:29, so I just want to hold you. So I'll just take so before I take some other questions.
Sir, please continue, sir. No problem.
So only problem is that I pushed my classes, which normally starts at 6:30 to 7:45 because our
Yeah,
program
you
is
can,
for
sir,
3:30. So
you can
therefore,
take 30 minutes more, sir. No problem. You can take.
I have my classes starting at 7:45. That's my problem. So I thought it's 5 to 7. Therefore, I kept it at 7:45.
Yes.
So unfortunately, I mean, I didn't notice it was 5:30. I thought it was 5 to 7. So that's why. But anyhow, so the one is as far as before I take the questions from the questions, some of them are already there. In my opinion, the JDA, the owner is liable to pay capital is there with certificate of completion. That is only when 45(5)(a) becomes applicable. So when 45(5)(a) is not applicable, so that's what we discussed pre 45(5)(a) and post 45(5). Trust that clarifies. If the landlord sells a flat out of his allotted flats before OC, I don't know what is that OC. So that abbreviation is something which I'm not able to understand what is the meaning of the OC.
Occupation certificate, sir. Occupation certificate.
Yeah, right. So, so the question here is that like the landlord sells the flat of the allotted before, I think, how to deal with it. So as mentioned, 45(5)(a) will not apply. So once 45(5)(a) is not applicable, you have to apply the provisions of 45(1). So once you apply the provisions of 45(1), what we discussed before JDA provisions, that is how you have to compute the capital gains. One is the date of entering into the joint development agreement will decide the date of the taxability, that year of taxation, and two, the cost of construction of the flats will be taken at the full value of consideration as against the stamp value. Trust this point clarifies your question. So building completion notification submitted by the applicant was on 10th March and the occupancy issue date is 11th June. So building completion notice, but if you go by the section, it doesn't talk about the occupancy. It talks about only when you got the completion certificate. So once the project completion certificate is, it's not about submission. The date of submission is not relevant. When you got from the competent authority is important. So it's not about your completion notice is not enough. For example, in Chennai, the competent authority is the Chennai Metro Development Authority. So the day on which they give completion certificate, that will be the cutoff date, not occupancy issue or the date of submission. So maybe for the next 5 odd minutes, I'm ready to take some other question before I take that. So this is a very interesting question. So in the case of a joint development agreement, whether the builder can offer the income under section 44 AD, the receipts from the sale of flats is below 2 crores. So I'll just very interesting question. In fact, it's my favorite question whenever I deal with presumptive income. There are two aspects to this particular so there are two aspects of it. It's definitely the income can be offered under the presumptive income. That is not an issue. So long as the consideration is less than 2 crores, so presumptive income will apply. But the very interesting issue which I want to bring it to your point, whether the provisions of 43CA will apply. That was the an interesting point. As just like 50C, you have for 43CA for business income. So whether the provisions of 43CA can be applied, because if you look at 44AD, it talks about notwithstanding anything to the contrary content in section 28 to 43C. So the only issues in this particular case will be, suppose assuming the stamp value is more than the actual consideration, should that 8% be applied on the stamp valuation or on the actual consideration alone? So that is the one very interesting issue. But as far as your specific question is concerned, yes, the SSC can go for 44AD. So no issues at all. But the only question is that whether the provisions of 43CA should also be applied while applying 44 is an issue, considering the fact that the overriding provisions talks only about 28 to 43C. So, but for your question, answer is yes. Share of plots allotted to the owner and JDA, can the SSC owner claim exemption to 54? The answer is yes, that definitely the SSC not only he can claim for all the houses. The amendment in section 54, for the reasons which I've already mentioned, will not have any impact. The only question here is, when is the date of transfer? When is the flats completed? See, the transfer is not altered by 45(5)(a). So 45(5)(a) does not change the date of transfer. What if the builder could not complete the project within 3 years? And if you get the flats after 3 years, will you be in a position to get 54 is the only issue. The department could argue, since the completion of your house is after beyond 3 years, you have invested after the time limit, therefore you may not get the exemption. That could be the only argument of the department, where the SSC is able to show that the delay is beyond his reasons. Then we have a very interesting decision of the Karnataka High Court, Sambandham Uday Kumar. So where if the delay is not attributable to the SSC, then even if the construction happens after 3 years, the exemption can be claimed. But however, you can expect some amount of litigation in this particular case, primarily because of the fact that the date of transfer is not altered by the introduction of 45(5)(a). So if there is a delay from the point of view of the builder, there is a possibility of department denying the exemption if the completion happens after 3 years.
Sir, so there's one more question. If the construction is of commercial complex or mulgis and not residential house, will the SSC get the benefit of section 54, 54F?
So both you cannot claim, because the exemptions are available only for residential. So there can be some commercial houses also there, but for you to claim exemption, you have to be holding one purchasing, or you should be allotted only the residential house.
Members are requested to ask any question if required, because there's very less time left. Please.
I can take one more question. As I told you, I have classes at 7:45. So because since our program is up 7 o'clock, I postponed it to 7:45. I can take one question. Other questions I can take offline. Always available. Technology is always helps us to be in touch.
There's one more, sir. In case landlord sells flat out of his allotted flats before occupancy certificate, how to deal with it?
I think we already
done.
Yeah.
Sir, please share the PPT also once, so that it will be for the benefit of all the members.
Definitely. So if there are no further questions, I really once again thank the organizers of all the 2 branches and 1
CP chapter.
CP study cycles for giving me the opportunity, and apart from it, also making my good friend as a chief guest. It's a great pleasure in sharing with him, as well as have a long discussion with him in the morning in connection with this program. And one thing is that a lot of questions and a lot of participation I really enjoyed going through it. I would personally like to come to Warangal or the place near you and address personally, because it's a long time since we met personally. But still, thank you for your patience. Thank you for the opportunity. It's wonderful sharing few thoughts with all of you. Thank you. Over to the organizers.
Thank you, sir. Thank you so much for your wonderful lucid presentation. Even though the JDAs take more time, it is long session, maybe half a day it will take.
Yeah. See, I think we should have a program combining, from a legal perspective, from GST perspective.
GST perspective.
Yeah, I think that should be a one full day program. Today is just an eye opener on what are the implications. That's all. I think we should have a separate program
Only
for
full day seminar. Full day seminar,
Absolutely.
physical seminar will have from
Yes,
starting
yes.
starting to till the capital gain.
Yeah,
completion.
end to end.
End
No,
to end,
apart
yes,
from
sir.
capital gains, you have business income. We have to see from the point of builder. There are a lot of them difference between JD and joint venture, how that structures. I think it would be a wonderful this thing. It should have a one full day program. So
Yes, sir. And
I'll be very happy to be part of it.
yes, sir. Yes, sir. Actually, young professional can take this as a specialized specialization.
Yeah, yeah. My request to this, please take the 20 days window available. There are some. I already shown some 5-6 do the research.
Yeah, that's a really interesting thing, sir, that you show that it's
I'll tell you that they're definitely for long-term investors generally not lost. Because I have been in the share market for close to 30 years. See, it is not. I mean, trading is always riskier, but investments are definitely not riskier. You need only a patience, be in practice or in stock market. Everything requires a patience. Now you can't come to practice. Like first 5 years, no work, no fees. That is the most dangerous period. Work is also not there because after finishing CA, if you sit in the home, your parents also don't know what to say. Next 5 years, only work, no fees. Next 5 years, work and peace. And the final phase, like I'm sitting here, in my name, they will send an opinion and charge. So therefore, whether you work or not, there is a fees.
no work and fees. No work and fees.
Yes, that is the stage we have to reach. So wishing all good luck and especially young professionals, come to practice, enjoy the practice. It's just the patience is what is required. And once they're there, I'm sure it will be very rewarding. So
thank you, sir. Thank you, sir. Thank you, sir. Now I request our Warangal branch chairman, C.A.G. Ravikumar Garu, to give his closing remarks. Over to you, sir.
Sir has gone, I think. Yeah. Thank you, sir. Thank you, Suresh, sir. I think sir has gone.
We can complete this thing, sir. Yeah, at the end.
Yeah.
No, I'm there.
Yes, sir.
Sir,
Yeah,
without
only
your
2
vote,
minutes,
thanks,
sir.
I will not.
In 2 or 3 minutes, we can leave you, sir. No problem.
No problem, sir. Absolutely.
Yes. Sir.
I've already asked them, my office people, to inform I may be slightly delayed. So,
Sir, thank you, sir. Thank you very much for accepting our request and taking this session very lively. Especially there are so many tricky points in JDA agreements and taxability of JDA agreements. There are so much of air in our mind regarding so much of taxability of JDA transactions. Now today you have cleared some tricky points, in fact, which are pinching our mind. Such tricky points you have cleared. We are very much thankful to you, sir. It's very lively session. And in future also, sir, we welcome you to Warangal, sir. There are so many good places in Warangal, historical places are there. Recently, Ramappa was notified by UNESCO as a historical place. And there are 1,000 pillars temple, Bhadrakali temple, and Fort to Warangal. And one more thing, sir, our original name is Orugallu. The name of Orugallu is Dravid word, sir. It is a Tamil word. Actually, Warangal word came from Orugallu. Orugallu. Ekashila Nagaram. That it is the name of itself came from Tamil word, sir. Warangal is very historical place. You are most welcome with your family, sir. We will provide all facilities. You can have sightseeing also in Warangal, sir. Please welcome, sir. Suresh, are you ready?
Sir. Sure, sir. Definitely. It will be a pleasure to come there. Nothing like physical addressing, whatever. So technology enables, but that the human being is always a social animal. No? So always nothing like meeting you personally and sharing the critics.
Yes. And in future also, as you suggested, we will have one day full session, sir. GST as well as income tax liability on especially JDA transactions, taxability of landowner, taxability of builder, taxability of flat owner, or whoever it may be, the full 360 degrees coverage of all these related transactions from indirect tax point of view and direct tax point of view.
And also
Sir, we
how
will
to-
also invite you.
Yeah. How to draft the agreement. We can also engage specific lawyers also for this, so that we get the total picture. So it should be a full day program. It will be very, very useful for you.
Yes, sir. And it is a custom in Warangal and Karimnagar branches and Nizamabad CP study chapter, sir. Whenever speaker comes and addresses like this at the end of session, we as a token of appreciation, we give an e-certificate, sir.
Okay.
E-certificate, sir. I request our branch head Suresh. His name is also Suresh, sir. Whenever I say Suresh, that is yes, sir. This is and I also
Kindly accept. Kindly accept.
kindly accept.
Thank you, sir.
Kindly accept it, sir.
Definitely,
And I
it's a
also
pleasure
request all
and
the
honor.
members, all the delegates, all the viewers, please unmute yourself and give a big round of applause to our speaker today for his beautiful presentation. Suresh. Thank you, sir.
Thank you, sir. Great pleasure. Thank you.
Thank you.
Thank you for the
Thank you,
wonderful
sir.
opportunity.
Thank you, sir. Thank you.
Meet you in person soon.
Thank you, sir.
Please
Thank you.
welcome.
Hope so, sir.
Thank you, sir. Thank you. Thank you for the session, sir. Now I request for the now I thank all.
Members.
Thank to the Warangal branch member, Karimnagar branch members, Nizamabad chapter members for making this program as a grand success. And thank you for coordinating management committee of Warangal branch, Karimnagar branch, and Nizamabad CPE committee. Thank to the branch heads and media. Thank you to one and all.
Especially managing committees of 2 branches and CPE.
Yes, sir. Especially, yes, sir. We are jointly programming. Even we are planning the forthcoming days. We have planned jointly several events in virtual as well as physical also. Thank you.
As Shekharji mentioned, it's a good joint development.
Sir. Thank you, sir.
This is 11th virtual seminar, sir. Jointly we are conducting. All
Great.
11 virtual seminars conducted by us jointly, and all are well received by the members, sir.
Absolutely.
Highest participation is 90, sir. Highest participation 88 to 90 we touched.
Great, sir.
Yes.
Fantastic. Thank you.
Thank you, sir.
Thank you, sir. Thank you.
Bye, Anjanelu.
Sir, bye.
See you soon. Malli maatladam tarvata.
Definitely, sir.
Ambarish has gone on.
Ambarish also left, sir.
Yes, he left. He's in hurry. I think this may be the last seminar for him.
Only.
Yeah, his tenure is coming to an end.
Okay, sir. We'll meet you, sir, soon.
Right.
Bye.
Bye.
Thank you.